Software stocks have barely moved in 2 years, while the Nasdaq has exploded up by 70% in the same period, and that has created a powder cake opportunity for us. I am the guy who bought oil stocks 6 months before the Iran war started, not because I have a crystal ball, but because I could see the big money moving into oil stocks, and I am up about 60% on that, while the SP is down single digits. So I made like 5 times more than the market, and I believe this rotation could be even bigger and faster. Why? Because I noticed that the big money is moving faster and faster from bucket to bucket, from sector to sector. They hop. And the truth that nobody tells you is that Wall Street no longer buys stocks for their quality. They do not care about their profits. They do not care about management. That time has passed. All they care about now is momentum, and it may sound fickle. I know you are used to this buy and hold philosophy, right? We have all been taught it, our parents were taught it. But if you do not understand this, you will get left behind. You will hold software stocks and you will make 0%, while the Nasdaq does like 70%, or you will play it safer. The SP, and you make 2%, like the 6 months before the war started, and people like me make 40%, because we bought oil stocks on the right moment. So in the next 20 minutes, I am going to explain this opportunity to you. I am going to give you both an ETF, so an index fund, and 3 individual stock opportunities. And if you want to understand that, stick around. I warn you though, the video is going to be fairly information dense, even though I am on the move here in London in a hotel room, but to make sure this really lands for you, I am going to give you more than just this video. I am going to give you a full bonus free research report on everything that I am covering here, plus more than we have time for in this short video. You can download that at felixfriends.org/software.so. It is free. And I mean truly free. It is just there for you. Take advantage of it. Link is down below in the description. Let me show you something first that most people are missing. Over the last 2 years, 2 things have happened that created a crazy mismatch. The Nasdaq 100 tracked by QQ. If you are an index fund investor, it went up about 70%. So if you invested $10,000 to the Nasdaq in 2024, by now you would have about $17,000, which is pretty good, right? But software stocks, the biggest software companies in America, they did not just go up slower. They actually went down in the same time period. So we are talking about decline of about 8%. So instead of $10,000 turning into $17,000, you would be sitting at just $9,000 in a bit, while your friend who bought the Nasdaq stock made loads of money, right? So how is it possible that software, which is supposed to be the future, is going down while everything else is going up massively? And that is exactly why this is creating an opportunity. Of course, the question becomes, why does this gap exist, right? Why would professional investors, the people managing billions of dollars, deliberately bet against software? The answer will tell you everything you need to know. There is a narrative going around Wall Street right now, and it is a very powerful narrative, powerful enough that hedge funds, the smartest money in the world, are betting billions of dollars against it, and they have been doing it for 2 years. They made lots of money on this, and the narrative is this: AI is going to kill all software companies. Why? Because AI can do what those software companies do, but better and faster. It kind of sounds scary, right? You are a software investor. So hedge funds decided to make money on the fear. They probably also created the fear, right? So those hedge funds just so far this year have made $24 billion betting that software stocks would go down. Think about that. $24 billion on just a one bet, and when that much money is betting on one direction, it creates an imbalance. Think about it this way. If all your friends are standing on one side of a boat, what happens? You move the whole boat. Everyone is crowded on one side and the boat gets, lopsided. But here is the thing about boats. The more crowded one side gets, the more likely this to tip the other way, because people will notice and think, oh my God, they are going to fall over. Let us run to the other side. And then everybody wants to the other side, and you do the opposite. Now, this video is not about convincing you that AI will or will not kill software. It does not matter to us. I am here to show you how to potentially profit from what happens next. Regardless, the bottom line is that investing used to be like planting an oak tree. You would buy a famous company, you would plant it in your brokerage account, you would ignore it, and you check back in 20 years and what a beautiful tree she would be. But today, the world changes too fast for that because of AI and rapid technology shifts. A company that looks like a mighty oak today can be chopped down to nothing in just 2 years. So if you just buy and hold one company forever, you might end up holding it all the way down to zero. So what do the Wall Street pros do instead? They surf. Instead of marrying one stock, I always say do not marry the stock. Marry the girl. Wall Street has one simple rule you need to learn today. It is called follow the money, and it is so important. I am literally going to hold a free live seminar this weekend, and it is called Why Buy and Hold is Dead in 2026, and what Wall Street does instead. I'm going to hold it live this weekend from France. Get yourself a free seat. There is a link down below at buyandgrow.net.notbuyandhold.net, buyandgrow.net. And the strategy that built your parents' wealth, it just will not build yours. So come and learn what replaced that strategy. Get your free seat, and this will work for you whether in the US or in the UK or in Europe. Just be on time. There will be no replays. Do not ask for them. And if you are worried about stock picking because sounds complicated, right? Look, this can be done with index funds. It is simple. It is not complicated. I am going to teach it to you. Grab yourself a seat. And if you are grabbing yourself a seat for that live seminar, write seminar in the chat down below, and I will know you have actually booked it. But right now, I am going to teach you a framework that professional investors use to spot opportunities like this. We are then going to look at what index fund we can buy to take advantage of this and what 3 individual stocks we can buy to potentially take advantage of this. So the framework is called, or I call it, the rubber band effect, and it works because human nature does not really change. Imagine a rubber band, right? When you stretch a rubber band really, really far in one direction, what happens? What happens? It gets tight, right? The further you stretch it, the more pressure builds up inside of it. And eventually that pressure becomes too much and suddenly snap, it whips back in the other direction. It snaps even harder than when it was stretched. Stock market works very much the same way. When everyone gets crowded on one side or betting on one direction, you are stretching the rubber band. The more extreme the crowding, the more pressure builds up. So what we are seeing with software is a rubber band stretched about, as far as I have seen it, in years. And professional investors know this, so they are watching and they are waiting for the snap. And what is really beautiful about this is you do not need to guess. There is a process to identify when the snap's about to happen. And if you know the steps, you can be ready when it does. So let me give you the big picture 3 steps here. We are going to go much, much deeper on this on the weekend if you join me there. The first step is figuring out exactly how crowded is one side of the boat. Professional investors, they track something called positioning, and this is basically a measure of how many people are betting up versus how many people are betting down on a particular stock. Normally, positioning is pretty balanced, right? So you have some people betting it up, some people betting down. It is like having people on both sides of the boat. But right now with software, it is incredibly lopsided. Way more money is betting down on software than is betting up, and here's a simple way to think about it. Usually the ratio of people betting down to betting up is pretty small. It is pretty similar, but in software that ratio has gotten crazily extreme. We are talking about short selling, which is when people bet the stock will go down at levels we have not seen in years. I mean, you see, positioning this extreme, it tells you something. Everyone who wanted to bet software would go down. Well, they have already made the bet. There is not much room left for more people to pile on. So if information comes out that makes people think software is not going to disappear, I mean, have you canceled your Microsoft subscriptions? Probably not, right? Because the reality is that yes, it is much easier to make software nowadays. But to acquire millions of subscribers like Microsoft has, that is just as hard as it was before. The second step is to look for the crack. I know my only joke's about that in the comment section. It is the first sign that the boat is about to tip over. And it is when the price of a stock breaks through a level where a lot of people thought it would stay below it. And if I may qualify you with a stock chart, this is a major software ETF called XSW, and it is trading right now pretty much exactly where it was in February. It has done like really absolutely nothing at all, you can see, but it is breaking through a level here. We are going to get a little bit more into that on the weekend if you join me there. But do not worry. This works for like all levels of understanding of investing. You see, we had a high here, and a high there. And right now we are at that same point again. And that point sits at basically $160. We break above that. It changes things. It is like the rubber band starting to slip from the hand that was pulling it. And when a price breaks through a level like this, it sends a signal. And when your industry has been stuck for months and months at the same level and you break through that glass ceiling, that is the crack we are looking for. That is the first time you heard this. Brilliant, right? First time in the comments. And I know that is since landing for you, but then there is a third step to this, and the third and the final step is the scariest part. It is when the boat actually tips. So once you spot the crack, the final step is understanding what comes next, and it is called forced buying. So here's how that works. Remember, all those people who bet software would go down, well, when the price starts going up, they have a problem. If they do not act, they are going to lose money. So what do? They rush to close their bets. And the only way to close a bet that the stock will go down is to buy the stock. You might have heard about shorting. This is what this is. You are shorting a stock. You are selling it. You do not own it. You have sold it. So you minus a stock in your portfolio. The only way to go back to zero is to buy a stock to get back to zero. And it creates a rush of buying. And these guys are not buying because the stock of the industry is getting better. It is just mechanical buying. It is forced buying. It is the rubber band snapping back. And when this happens, the move can be fast. I mean, we are talking really fast. Let me give you an example of one of these. A recent one who has heard of a Visa car company, really boring stock, right? But this is what forced selling looks like, or rather forced buying. They were closing their positions, right? So people hated Avis. They thought it was going to go down a lot. And in fairness, they made a lot of money doing it because it actually went down 50%. But then when it started going up again, first gradually, and then really rapidly, right? Hundreds of percent. And then of course it collapsed again. And the smart investors are ready for this on software. So the simplest play, and I am not a financial advisor, I am not a registered investment advisor, I am not telling you what to buy. I am just sharing with you some research and some insight and some education that I got from my Wall Street mentors. The simplest play is always to buy an index fund, right? It is the easiest way to do this. Now, The index fund for this that I am looking at is called XSW. And if I go into our ETF tool here and I see XSW there, I can click on that and I can see exactly what it does. You can see it is done. It is actually down 7% in the last year. You can see it is mostly invested in the US, which is what we want. You can see the top holdings here and some Winston explanations of what it is actually all about. And it holds basically 136 of leading software companies out there. And it is the safer, that was a word one can use for investment. Of course, there is a risk with everything. There is massive risk with everything, but it is a safer play than buying an individual stock, right? So if the squeeze happens, if the money pours into this, the whole thing will go up. But if it does not happen, it probably will not go down as much as if you pick an individual stock. So what could actually trigger it? Well, it could just be no real news and just money slowly, gradually pouring into the industry as people are closing their short positions. It could also be a good earnings report for one of the software majors. It could just be that the fear thing around AI goes away because, Microsoft has just built AI into their software offering. Nobody canceled their Office subscription because someone came up with a free word processor, right? I mean, Google did. There is Google Docs is the same thing. It is free, right? Did that impact Microsoft offer? No, it did not, because everybody is on that subscription. Everyone has got Windows and Microsoft Office installed. Companies are not going to change their software because someone else does it a little bit cheaper because it is a pain in the neck to train everybody. So they just do not do it. But yeah, the key thing, of course, what will make this the biggest would be forced buying. So we get those margin calls, we get those shorts closing, and then you get panic, and then you can go and get yourself, in theory, like, what happened to Avis, just one of these crazy, crazy stories, right? How quick does this happen? We are not talking about days. This can be weeks, it can be months, but I also want to walk you through because I promised you the 3 stocks that I am actually looking at here. 3 individual stocks, and those are CoreWeave, Big Bear AI, and Unity Software. So I am going to give you a straightforward explanation for those. We are looking at the stocks, the chart together as well. And again, I am not telling you to buy them. I am just saying this is how I look at opportunities, and this is here's why. And CoreWeave is essentially a specialized cloud for AI training sort of company, right? So they are not your average Microsoft or Amazon style cloud provider. They instead build a massive network of data centers packed with just the world's most powerful GPUs, which is exactly what AI companies need to train and run their biggest models. Sort of the kind of the premium fuel when you get petrol. It is just built for the AI. Boom. And AI computing power demand is just growing faster than pretty much anybody expected. These guys have long-term contracts. Massive backlog of future revenue. They have also partnered with NVIDIA. They are expanding your capacity aggressively, and basically the whole AI industry needs more of what they sell. So if AI adoption keeps going on the way we are seeing it, then these guys are going to collect a lot of money, right? If you look at the chart here, what do I see? Well, we have just broken out over slightly the recent highs here right now. There is a little bit further to go. And if you wanted to be a little bit more cautious on this, you would be looking more at like the $140, which is a few dollars above where we are trading right now. And that would be a cleaner kind of breakout. But what we are seeing is that we are gradually moving up again, right? So the big sell-off is over and we are gradually repositioning here in a good way. Stock numero 2 is Big Bear AI, and I am as cautious as anybody companies that put the word AI in their title because it reminds me of .com. It is down about 60% from all-time highs, and actually, no, it has done a lot more than that. It is down about 70% from all-time highs, and I actually quite like that because it is possibly overdone. Big Bear AI builds AI software that helps the U.S. military federal agencies process massive data, and so sort of think logistics, predictive intelligence, that kind of stuff. And the bull case is simply the U.S. government is in the middle of a major push to integrate AI into national security, and the defense budgets for AI are just growing, as quickly as anybody would have thought. So these guys, BBuy, have been winning key contracts. They got a backlog. They got real contracts with the U.S. government, and it is a pretty small name still that could become a meaningful player in the whole sort of defense tech space that is out there. And what are we seeing? Well, we are seeing a stock that seems to bottom out around $3 and is actually moving back up. You can notice that yellow line there we talk about more on Sundays starting to move back up right now. There will be resistance on the way up. It will not be a straight line up because as you get into these sort of zones here, the suckers who bought here, they are going to sell at 0, right? But it is moving. It is showing early signs of this could be an interesting one, which is why I am mentioning it. Again, I am not telling you to run out and buy it. The third stock is called Unity Software, and it is the engine that millions of developers use to build video games, training, simulations, Arkansas experiences, all that stuff, and even digital twins for automotive industries, architecture, and so on. And they have got some new AI tools called like Unity Vector, for example, that help games and apps generate revenue more efficiently through ads and app experiences and so on. And the gaming industry is not shrinking, right? People are still playing games, and it is actually evolving faster into virtual worlds and so on. And Unity dominates the greater tools market. They have been streamlining the operations to reach more profitability. And a lot of people are looking at this and going, this is actually an undervalued stock right now, right? And again, this has come down from some pretty lofty highs here, right? And I quite like that in these sort of setups. It is down about 87%. Talk about being punished, right, for being software. And what are you seeing again? It appears to have bottomed out around $17.50, which is pretty much the same level we were at the previous year, 2025, 2026. And we seem to actually be looking at potentially a meaningful rally here. Now, of course, you have to know when to sell and how to set it up, and you have to responsibility for position sizing and everything else, and think about how it fits into your portfolio and all of that. But the quick bull case here is for each of these CoreWeave Big Bear AI infrastructure. Boom. Big Bear AI rides the wave of AI spending and defense, and Unity is sort of at the center of game development. Now, are there more layers to this onion? Yes, of course there are. I cannot teach you everything there is about investing in these sort of momentum plays in a 20-minute video, and which is precisely why I'm running a live training for you guys on the weekend where you can ask me questions, where it will be, live and interactive, and I will going to walk you through the more detailed setups that work not just for software, but like for everything, and have been like that for many, many years, because I very, very firmly believe that the old playbook, the buy and hold playbook, it does not work for stocks. It does not even work for sector index funds. It probably works for the SP 500, I think. That is very fair to say, because that is in the long run always going to go up. But if you are someone who is buying individual stocks, or you are buying, an AI ETF or a tech ETF or something quantum ETF or whatever it might be, you need to realize you cannot just buy them and forget about them, because the speed at which money moves around now is greater than ever. And it is largely because technology interruptions are just faster and bigger than ever before, right? I mean, we used to have the leading phone company in the world was called Nokia, right? Then it was BlackBerry for business. They are pretty much out of business. Cisco was the most exciting software company around. And you can think of, thousands of such examples, and the money went into them and the money left, and it found somewhere better to make money. So come and join me on the weekend. It will be free. It will be live. It will be live from France. It will be fun. Buyandgrow.net, and I will teach you the exact system that I use every single week. It does not matter whether you are a trader, whether you are buying stocks or index funds. If you are just interested in how to responsibly grow your investments further, come and join us. Link is down below in the description. You got some value from this. You think someone might get value from the live seminar? Send them the link. Share it with the people, and I wish you all the best. What if I told you that 1 year ago, almost to this day, I sat here? Well, not exactly here, but I sat somewhere and I took a look at 2 tiny quantum computing stocks. Almost everyone was ignoring them because they were considered too risky or too early, but the positioning was extreme. The rubber band was stretched, and within 3 months, those stocks had doubled while the rest of the market was flat. That is the power of understanding liquidity flows over fundamentals. If you keep waiting for the perfect financial statement, you will be buying the top while people like me are already moving our money into the next sector. You do not need to work harder. You just need to stop being so stubborn about the way the world used to work. The world of 2026 moves at the speed of an algorithm. If you are not positioned before the algorithm snaps the rubber band, you are just providing the liquidity for the professionals to exit. Think about that while you are holding your legacy software stocks that have not moved in 24 months. The boat is tipping. The only question is which side you are going to be on when it does. I will see you at the seminar. It is time to stop playing the game the way they taught you in school and start playing it the way it is. Actually being played in the dark pools and hedge fund offices. Right now, be there or keep wondering why your portfolio is stagnant while the rest of the world is moving on without you. Peace.